The European labor market is on the cusp of its own flat Beveridge moment, a danger that is amplified by what's happening in Switzerland. The Swiss just reported a major contraction in GDP, which, as we know only too well the last couple of years, Switzerland is a global bellwether. And if all that wasn't enough, German economists, mainstream German economists working for the German government just said, this idea that Europe is in a good place and that European policy is in a good place, yeah, they're not seeing it either. Now, we've talked a lot about the U.S. labor market, especially recently, and the confirmation we've gotten on its journey into the flat part of the Beveridge curve. I also did a video yesterday on China's crashing investments and what those say about the Chinese beverage. Now we've got the Europeans putting up the same sort of numbers as both of those where it comes to jobs. Now, right now in Europe, the estimates are still positive as we've seen all these other places, but barely, which means the central bankers at the ECB will say that's a good place when in reality, it is absolutely the wrong way. And the German Council of Economic Experts just said so in a statement last week, criticizing basically everything over there, including Berlin's big bazooka. Plus, the Swiss just reported, as I said, a sharp contraction, even as the Swiss National Bank does its best to say Switzerland is in a good place and it doesn't need negative rates. The Swiss bond market continues to beg to differ, and so too does the Swiss economic data. It wasn't just some random coincidence that it was the Swiss National Bank which kicked off this global rate cutting cycle over a year and a half ago. And interest rates over that year and a half have gone a lot lower than people were anticipating. And the reason why is what the Swiss were telling us about global economic and monetary conditions. Now, the central banks around the world, including the ECB, starting with the ECB, are trying to tell us that everything's in a good place, in large part because of their rate-cutting response. When European workers and Swiss GDP, and now German economic experts all vehemently disagree with that idea. Now, Eurostat, Europe's main economic statistical agency, reported last week that GDP growth was the same 0.2% in the third quarter that had been figured initially a month ago. To the ECB, that represents a solid number indicating Europe and European interest rate policies are, as we've heard so much, in a good place. And this is yet again another example of confusing a positive number for a positive outcome. And it is, in many cases like this one, intentional. Central bankers know this is not a good development. However, they've been forced to flip into psychology mode after lowering the policy rate down to 2%. And Christine Lagarde really does not want to go any lower. Officials wrongly believe they need to save some rate-cutting powder in case things go from small positives that are really negatives to outright negatives that are consistent with a full journey down the flat Beveridge curve. So in lieu of cutting again under 2%, European central bankers have quite transparently and even blatantly started chanting the phrase "a good place," basically in unison, trying to reinforce sentiment, hoping that such psychology will keep Europe from really visiting the flat part of the unemployment curve. And as we'll see, the German experts aren't the only ones who are skeptical of this new policy effort and the lack of evidence behind it. So let's go to Euro news here. Eurozone GDP barely grew in the third quarter of 2025, rising just 0.2% as the wider EU posted similar weak gains, and unemployment remained flat. New business registrations increased, but a sharp rise in bankruptcies across key consumer-facing sectors could highlight a market under pressure. The latest flash estimate from Eurostat points to continued, if fragile, growth across the Eurozone. According to the provisional data for the third quarter of 2025, seasonally adjusted GDP in the Eurozone increased only marginally on the previous quarter, with the European as a whole showing similarly modest gains. A quarterly rise of just a few tenths of a percentage point does not signal a robust rebound and is more akin to a hesitant step forward. While you can't argue with the skepticism expressed in the article, I don't think Europe's small GDP increase should be viewed as a step forward at all, hesitant or otherwise. When you look at the forgot how to grow world, the issue isn't positive or negative. It's always whether any economic account, whether it be GDP or employment, as we'll see, is expanding enough to suggest the underlying real economy is either keeping up or, better still, closing the forgot how to grow gap. At just 0.2%, following a 0.1% in the second quarter, European output is almost certainly still falling further behind, not even keeping up. The only positives that look like Europe might have turned a corner were last year and the start of this year, which we know were artificial highs that were induced by front-loading activity to beat the trade war tariffs. Now, the bigger problem for the ECB and the European economy, really the entire world, is that without legitimate economic growth, labor utilization necessarily slows down to the point It puts the labor market right within sight of the flat Beveridge curve, the flat part of the Beveridge curve, the same one that we're trying to avoid. And the same Euronews article at least does understand the danger here. Quote, while the job market in the Eurozone remains relatively tight by historical standards, the fact that the unemployment rate is flat in the Eurozone and only very slightly lower in the broader EU suggests that the labor market is not significantly improving as growth remains weak. Youth unemployment is also largely flat, meaning that younger workers are not gaining noticeably from any rebound because it actually isn't a rebound. When you examine the data and do so honestly, what I said about GDP goes doubly here. It isn't whether the number is positive or not, whether it be output or employment or anything. Is it positive enough to begin erasing the growing employment gap? And that's the big one that we keep coming across. And the answer is quite clearly no on both GDP as well as employment. So last week, Eurostat gave us their preliminary estimate on job growth in the third quarter to go along with its update to GDP. And like GDP, European employment was also positive, if barely, rising just 0.1% quarter over quarter. So Christine Lagarde will take that number and shout in unison with all of her minions, Europe is in a good place, when by any reasonable standard, any reasonable honest standard, completely obliterates that idea. Just look at the data in relation to the baseline. European jobs are falling further and further behind. And unemployment is, according to the numbers the Euronews article cited, flattening out. In many places, it's already stacking up. And taking it a step further, when you measure employment growth on a year-over-year basis in Europe, for the third quarter, it slipped down to just 0.5%. So again, once more, it's another positive number, which economists and central bankers want you to believe is proof that everything is in a good place. But European employment has never gone below 1% year over year without a full-blown recession following up on it. That was the case leading up to 2008, back in 2001, plus the almost forgotten devastating double-dip recession in 2011 and 2012. In that case, employment turned positive by the fourth quarter of 2010 and even got to 0.3% on the plus side by the middle of 2011. That was never enough, and then it dropped right off during the Eurodollar number 2 crisis. So what the European employment data shows, like GDP, is that there actually isn't any growth, just a few positive numbers. And because these are nowhere near positive enough, Europe continues to fall further behind, and as it does, the risks of turning even worse conditions, going into full-blown negatives again on jobs and GDP, are exceptionally high. And just a reminder, the markets have been telling us to expect all this, whether it be the United States Beveridge, the Chinese Beveridge, or now the European Beveridge. All of it has been expected by the marketplace, which is why I keep talking about this one very important, maybe the most important monetary signal that we have. And because it's that important, because now we can see the consequences more clearly emerge, I'm making a video available about that signal, what it is, what it actually means. There's a link in the description. Follow that link, watch the video, understand what we're talking about, and understand there's a lot more beside it. So it's the one biggest, most important monetary signal that we have, though it fits with everything that we're now seeing. And even more so given how globally synchronized this global economy is. We've been seeing rising unemployment in the UK, in Canada. We've been talking flat Beveridge in the United States and China, two of the biggest economies there are. So of course Europe is going to be doing the same thing. It is globally synchronized, and that's why interest rates go down by a lot, and stay there a long time. It's not just a danger. More and more, every time we go through these things, every time we see the data, what it shows is further along in that direction, never moving away from it. Globally synchronized flat Beveridge. So over in Germany, the German Council of Economic Experts sort of agrees with all that. Now, these are advisors to the German government, and they just put out predictions and especially statements that are at odds with several of the official government projections. The latter indicate that growth is supposed to pick up next year in Germany, maybe rising to 1.3% after a third straight year, basically nothing in 2025. But the council, on the other hand, just lowered its 2026 figure to just 0.9%. And while that might not seem far off from the official estimate, it is night and day, especially considering, just as a start, the downside risks that are far higher than the 0.9% make it appear. Plus, this is the fact that they're downgrading from their May assessment, showing that they're recognizing that these are not just downside risks, they are downside reality. So referring to the globally synchronized background I just went over, the German council said, quote, The current weakness is caused not only by cyclical factors, but also by profound structural change and geopolitical shifts that threaten the German export model. However, the current period of weakness is not solely attributable to external causes. Domestic factors, such as a persistent decline in the competitiveness of German industry and the ongoing demographic aging, are also contributing to the unfavorable situation. And what hasn't contributed favorably to the situation is Berlin's big bazooka idea from earlier this year, which caused a huge stir, just like China's big bazooka, but not so much in terms of the actual economic situation. And so this comes at a very uncomfortable time for Germany. The government there, which only took over around 8 months ago, is already deeply unpopular. And it's the same thing every time. I keep pointing this out. When the rate of economic growth goes down far enough, even if it's still positive, the rate of change in politics goes way up. In Germany, Europe's woeful economy has led to political upset in many places around the continent. France, anyone? And we've seen repeatedly, the new guys come in, they promise all sorts of stuff only to be unable to deliver, and so they end up shoveling a bunch of happy talking voters who aren't nearly so stupid as politicians and central bankers really wish they were. Voters act, they throw the new guys out and get in some even newer guys to come in. Rinse and repeat. And that's exactly what Bloomberg is saying here from last week. Pressure on the chancellor in Germany to deliver is rising. Support for his CDU-CSU bloc has dwindled since February election because nothing has improved in the German economy or the European economy, according to opinion polls, while more respondents say they would vote for the Alternative for Germany if another national ballot were held, lifting the party into first place in some surveys. It really is the economy, stupid. Only it's politicians, central bankers, and normally economists who are so stupid when it comes to the economy. Talk isn't even cheap. It no longer works, nor do positive numbers. Voters know the difference. Even if they don't follow every single statistic and know actually its relationship to the baseline, they don't need to. They can feel and see and experience the real economy as it actually is. And these numbers show it when you look at them in any honest way. Positive numbers, not nearly enough. Whether or not the economy is falling further and further behind is the only thing that matters, and it is becoming the only thing that matters. So speaking of increasingly bad, economists and analysts were expecting a setback in global bellwether Switzerland for the third quarter. Like Europe, Swiss GDP had accelerated modestly into the start of this year, rising 0.7% in the first quarter. But then, unexpectedly, that rate dropped to just barely positive at 0.1% for the second quarter. So analysts had penciled in a very small 0.1% minus for the third quarter, as they thought Switzerland was they're going to have to go through a very modest and temporary trade war payback. Very modest, very temporary. Instead, the Swiss government reported earlier today, GDP fell by 0.5% in the quarter, 5 times the rate that was expected. And it was the first negative GDP estimate since the quarter following Credit Suisse in 2023, and only the second one since the 2020's pandemic and lockdowns, with this one being by far the worst contraction. And why was it so sharp? Well, first of all, the payback in terms of trade in the global sector was far bigger than everyone was thinking. Switzerland's State Secretariat for Economic Affairs, in their statement, they said the drop was, quote, driven by a sharp decline in value added in the chemical and pharmaceutical sector. Industry as a whole recorded negative growth. But then they also added the services sector grew at a below average rate. So it even seeped into services industries along with other parts of the goods economy beyond strictly pharmaceutical and chemical. So hearing that, you probably won't be surprised to also hear that Swiss unemployment has been creeping higher along with these unexpected economic setbacks. The official unemployment rate for October was set at 2.9%, which is 0.4 of a percentage point higher than in October of 2024. Now, you should know the jobless rate is not seasonally adjusted, so we look at how much it might increase or decrease in some cases versus the prior year to make some judgments on these Beveridge mechanics. And while 2.9% is low, for Switzerland, it's actually higher than both October 2019 and October 2018, and it is equal going all the way back to October of 2017, while you can see, most importantly, also moving in the wrong direction higher at the same time. So in terms of consumer prices, which the Swiss watch, pun intended, very carefully, Switzerland's CPI unexpectedly dipped back to near zero in October as well. It had been zero and then slightly negative back during the deflationary chaos of April and May. It rebounded to just 0.2% on the plus side in July, but rather than accelerate along with the economy as everyone was hoping and expecting during the summer, it first flatlined right at that near zero level before here last month taking another step back and another step down. So for its part, the Swiss National Bank held its policy rate at zero in September, which was the first pause for the SNB in the current cycle. And while SNB officials, starting with Martin Schlegel, continued to recite the Swiss equivalent of the economy being in a good place, the bond market does not agree, nor does it think the SNB will be able to hold itself at zero for very long. Negative rates in Switzerland are still more likely than not, with a good chunk of the Swiss bond curve yielding less than zero, and the rest of it barely positive. Like European GDP and employment, barely positive for government bond yields is not a positive sign either. And Switzerland being a global bellwether, where we're talking about global trade flows or global monetary flows, is giving us another sense, just like it did in March of 2024, about where more than just the risks are lined up. It's not just that, oh, this could potentially happen. We're seeing more and more confirmation of all these economies, at the very least, falling further and further behind. Even if they have positive numbers, they're not nearly positive enough. And because they're not nearly positive enough, that's why you see the rolling over and the moving toward, in terms of employment and jobs, more flat Beveridge. So with money having poured into the safe haven of Switzerland, turning those government bond yields negative long before the S&P even got to zero, the money isn't pouring out seeking higher returns from a lower risk rebounding global economy, like everyone keeps saying. Christine Lagarde can, and she certainly will, keep repeating her stupid scripted phase of the European economy being in a good place, because that's all she has, short of taking the ECB below 2% and into historically low territory. But let's be honest, she's already there. I mean, 2% is historically low, and the reasons why are in these macroeconomic updates. The numbers might be positive, but they are decisively negative in what they suggest for what's going on right now, but more so the continuing downside case, especially on a jobs market in Europe that is tilting closer and closer and closer to a rendezvous with a flat Beveridge all its own. And of course, Europe's wouldn't be all its own, would it? American workers can see it, Chinese household banks, and even the PBOC now can see it. So can these German economists that are working for the German government. And while these central banks tell you that the economy is in a good place, they're doing so as part of a planned policy response to avoid, right now, having to go even lower on their policy interest rates. As I keep telling you, the economy globally continues to get more, not less, certain. And what it's certain about is the exact opposite of what it's supposed to be, and that's why we have to play all these games, including looking at positive numbers as if they're somehow positive, when by all accounts, they are anything but. Now, one place we didn't even have to worry about small positive numbers was China, especially in investments. Investments there absolutely crashed. And while that term is overused, it was not in this case. Got all the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.